Hello, everyone. Hello, everyone. Welcome to the fundraising certificate. So I just want to make sure that you guys are able to hear me. If you're able to hear me well, say yes. Yes, I can hear you. And you can do that on the GoToWebinar control panel on the question sections. You will be able to type in. Okay, great. So if you can see my video, myself, my image, can you say yes, I can see your video, or yes for video? Okay, fantastic. And what about the slides? Can you see the slides? If you can see the slides, please type in yes for the slides. I just want to make sure that everyone is able to see the slides, the video, everything. Okay, great. So just out of curiosity, where are you guys joining from? Which city? Which country? I see here Stan, Diana. Okay, so Jose from Madrid, James Sheets from Boston, Hervé from Paris, Jose from Basel, Switzerland, Stan from Boston, Don from Dallas, James from Dublin. I see here also from the UK, Diana from India, from Mumbai. Hello, Subsanu. It's great to have you here. All righty, fantastic. So basically the idea is that we're going to be doing 3 sessions together. Each session is going to be 1 hour and a half. So we're going to be doing one session this week, another one next week, and then another one the following. And really the goal of these sessions is that by the end of the third one, you have a clear idea on what's the strategy and also the psychology when it comes to raising money. And I don't care if it is from individuals or from institutions, but that you have that level of confidence in place. Now, every session that we have together is going to be very engaging. I don't like just talking, and then leave it at the end for Q&As. I know that many of you guys are actually now in the process of raising money. There may be some questions, some comments, some concerns, some challenges, whatever that you're dealing with. I want you to throw them into the GoToWebinar control panel section. Just ask whatever questions that you have, and then I'll be very happy to go ahead and address them. I think that really what makes the seminar powerful is not just me just talking and going through the content, but it's more you guys being part of it, participating, engaging with one another by asking questions here, by engaging as well in the Facebook group that you will receive an invitation to later. So that's really the whole goal. So yeah, so let's make this a really awesome seminar for everyone. So with that being said, let's go ahead and start. And I don't know if you guys have any questions in terms, before we get started, in terms of like logistics or anything about the course. Please feel free to ask those questions. Again, go to webinar control panel. You can type in anything and I'll be reading it out loud. Okay, so really quickly, just to introduce myself. So I'm originally from Spain, from Madrid. I've been now in New York City for the past 10 years. I came here to do my master's degree. Then I did a little bit of law. I was involved in investment arbitration cases. And then I went and took the leap of faith and started the business, OneBest. Actually, we got acquired this week. We made the announcement. So that was pretty cool. I thought at one point that I was not going to be able to make it for the seminar because there was a lot of back and forth. But yeah, but basically OneBest, what we built over the course of the past 5 years was an ecosystem of over 400,000 entrepreneurs in 232 countries. And the idea was to help them throughout the entire journey of building, scaling, and financing their business. I mean, we provided over 100 million in financing for like 60 or 70 companies. And many of the companies that formed in the ecosystem went on to be acquired by corporations like LinkedIn, Google. So it has been a really unbelievable journey. The other stuff is more kind of like the press. Which is, it's nice, but it's not important. People tend to get distracted with the flashes. And then what I'm really excited about is the book, The Art of Startup Fundraising, that I published a year and a half, 2 years ago now. And basically the work to be able to help others, in what I think it's a really brutal journey, a journey that involves a roller coaster full of ups and downs, full of emotions. And I think that as you see on the next on one of the next slides, really people don't fail at fundraising because, you know, or they shut down because of lack of access to financing. The real reason why it happens is because people don't have the knowledge to unlock that financing, because it's really not that hard to get in front of people. I mean, you just need to work your magic, get creative, and we're going to be covering that throughout the seminar. But it's the most important is about closing. And to do that, you need to know how to do it and when to do it. So as I mentioned, really the whole objective of this seminar is going to be to arm you with all the tools and all the knowledge so that you can raise whatever capital that you need to really execute, build, and scale your business. Now, some of you guys are at an early stage, some others are at a growth stage, but you know, there's all types of, you know, you guys have all types of profiles here. So just out of curiosity, how many of you guys are fundraising right now? Say yes if you're fundraising, or say no if you're not fundraising. Okay, great. So I see, okay, so most of you are yes, and then there is a couple of no's. Okay, fantastic. Well, thank you for that info. And this is the book, The Art of Startup Fundraising. It's going to be the book, by the way, that we're going to be using for the course. So I don't know if you guys already did your homework, which I requested that you did so that you were up to speed. And if not, you know, please do so. We're going to be covering multiple of the chapters. And that's the whole idea, so that you can really get the full picture of what it takes, no? And then I always like to begin every session with a quote. And the quote that I really like in this case is from Nelson Mandela. And that is that it always seems impossible until it's done. And that happens with funding. Funding, you know, seems like a huge mountain that you need to climb. And as you continue to execute and build your business, you're going to have like the different rounds, the initial one, which is the smaller one, and then the subsequent rounds, which are much bigger and also more complex. But really, you cannot get distracted with your own thoughts. You just need to have that self-confidence, a good plan in place, and you will be able to really get that money in the bank. Because at the end of the day, what is separating you between you and the money in your bank account is the concerns that are in between. So during this course, my goal or my intention or the purpose is to give you the tools that you're going to need in order to engage with those potential investors, so that you address their concerns, which for the most part are going to be the same towards your business, from this guy, so that you get the money in the bank. So one of the things that I was pointing out earlier is that 65% of companies fail because of lack of access to financing. This is one of the percentages. Now, what I always say and what I always share with founders is that, you know, the real lack there is that they do not know what is the psychology and what is the strategy. I'm not going to get tired from saying that. Okay, so let's see this. So the agenda really quickly for today, we're going to be having a general overview. We're going to be discussing the key players and then also the terminology. I see some of you, like for example, Diana, that is mentioning that you didn't receive the material from the class that we had yesterday, because right now we have the financial modeling course as well, which is something that we will discuss later on. But Diana, please feel free to remind me later today, if I'm not following up with you with these assets. I'll speak internally so that we get that to you. Alrighty, so the sources of funding. So in terms of sources of funding, the ones that you're going to see is, you know, the typical ones, the main ones are crowdfunding or ICOs, angel investors, and venture capital firms. Now, in terms of ICOs, I really want to cover this quickly, but ICOs now is becoming very popular for all these projects that are built on top of blockchain and that have tokens. So basically what you're selling is the tokens. Now, the problem with the ICOs is that I would say 95% of them are scams. There is a lot of fraudulent activity happening. And one thing that we've seen that is for the first time in history that happens is that retail investors have gained access to these offerings before institutional investors. I mean, now you're starting to see Goldman Sachs and other players that are starting to open up trading desks and things like that. But before, I mean, you would see venture capitals getting to the startups or to the entrepreneurs before the actual retail investors would, that would do it actually at a later time, you know, most likely when there's an IPO of the business. Now, one of my recommendations to the folks that are joining today and that are thinking about doing an ICO is that you should be very, very careful. And the reason why I'm saying this is because this market or this space has not really been regulated. And the problem with that is that now the SEC is going to really crack down on it. And there's probably going to be all types of subpoenas sent left and right, cease and desist, and also, you know, potential civil and criminal lawsuits. So I think that, you know, if any of you is planning on doing one, probably my guess right now is to stay away and try to find an alternative route, some of the routes that we're going to be discussing, unless you don't want to get on uncharted territories that may put you in a difficult position. Because the issue, and this is one thing that I always share with founders, is that when you're closing your round today, or when you're about to close your round today, you need to already be starting to think about what your next round is going to look like. And the reason for this is because when you're taking money, you're going to be changing the corporate structure of your business, and that may or may not impact how you're receiving money at a later point in the future. Some of the entities, if you're messing it up now, may not want to invest in your company, even if you have a lot of traction and your product is great and that they actually like you. So that goes for the ICOs. You have crowdfunding, and then you have angel investors and venture capital firms. We will talk about these two other in a little bit, but I want to jump into crowdfunding. So crowdfunding, for some of you that know or may not know, I was actually involved in the entire passing of the regulations. So I went to the White House, also went to the U.S. House of Representatives to testify to really pass this new law. Now, I'll get into some of my disappointments about it, but really there's different types of crowdfunding because people tend to put them all in under the same bucket. So you have the rewards crowdfunding, which works very well for like hardware startups, and you know, when you're selling like something that is tangible that people can see and touch, you're basically pre-selling your product. If you were, for example, and the beauty about that is that you're not giving away equity of your business. You're just basically giving a product, and they're paying you for it. So that's great. So if you can use that route, you know, and not dilute yourself or give away equity of the business that you're never going to get back, you know, I would recommend you to do that. The other one is equity crowdfunding. So this is where it gets a little bit more complex. You have equity or debt crowdfunding. The thing here that you're doing is basically giving a portion away of your business at a price that has been predetermined, either by you on the syndicate that you're building or by the institutional investors or individual investors that have decided to lead your round. Now, there's companies that perform very well on equity crowdfunding, and also there's companies that may not perform that well. Now, on rewards crowdfunding, it's very clear that I can tell you that if you're operating a potential high growth business that has an engineering component or is very tech driven, it's not appealing when you're giving away a t-shirt or a beta testing of your site. So that's why this type of companies, normally they're going to go to the route of equity crowdfunding or debt crowdfunding. Now, the issue with equity crowdfunding or debt crowdfunding is that you have a lot of regulations that are involved. Now, some of the hurdles that came with the regulatory landscape that was introduced is the fact that you could only raise a certain amount of money in a 12-month period. I don't know, like many of you guys are outside of the US, but for example, here in New York City, you see seed companies raising around the neighborhood of $2 million. So that means that if you're doing a 1 million raise, you're already shooting yourself in the foot. So that's a no-no. The other one is that there's upfront costs. So for example, if you want to raise money from one of these platforms, depending on the amount that you raise. So if you want to raise more than 500,000, you need to have audited financial statements. Now, to get that, it's going to cost you an arm and a leg. I mean, there is some of these auditing companies that are going to be charging you $50,000. So That means that before you even know if you're going to get any financing from the investors that are part of the pool of investors of these platforms, you're going to have to put money down up front. So that has a lot of risks because at this stage, many of you guys are early in the process, and I think that putting money down without really having that level of certainty, it could be very tricky, and it also can be very, very risky. And Jose Luis is asking if I can put the full screen slides. Unfortunately, I can't put it on full screen because if I put it on full screen, I can't see your guys' questions, Jose Luis. So the other thing is about the equity platforms is the adverse selection. So normally when you go into one of these platforms, the problem that you're going to be sending to the market, you're going to be signaling that many people have passed on your deal, specifically the classic investors, like, for example, the VCs. And that sends the signal to the market that you're going to one of these platforms because everyone passed on your opportunity, and then that was the last resource, and that's why you decided to go to one of these platforms. And the main reason for this is because if you can avoid all the administrative hurdles and the reporting, the disclosures, because once you raise on one of those platforms, you need to report every year, provide disclosures to the SEC. There may be information that also may be available to the public, to your competitors. So I think even though, it's crazy that I'm saying this because I helped to push, this industry since 2012, I was very disappointed, obviously, when the laws came out for the Title III on October of 2015. But I got to tell you, my advice, or if I was you, if I could avoid the equity crowdfunding route or the debt crowdfunding route, I would avoid it. Either go to the reward-based crowdfunding or go to the normal routes of raising money. So the other thing is that one of the issues is that when you do an equity round, you're going to have like multiple investors at very small check sizes. So $200, $300, $1,000. Now in the US, there is this thing called the SPVs, or special purpose vehicle. And it's a very good way to group investors. So that means that, for example, if you have 99 people giving you whatever amount of money, you can put those 99 into one single entity, which is kind of like an LLC. And then you put on top of that a managing member. Every SPV has a managing member. So that way, whenever you have to do a subsequent round of financing, or whenever your company gets acquired, you don't need to be chasing 99 people for signatures. Basically, what you do is you get in touch with that managing member, and you get that managing member to give you the okay and to sign the document. And that's all. Now, the problem is that under SEC regulation here in the US, you are not allowed to do SPVs and group your investors. Alrighty, so yeah, so Jamshid is asking if this is if he's asking for one of the platforms here in the US. Yes, so all these platforms that are equity crowdfunding platforms have this same level of operations. So Stan is asking, when do you need the audited financials? So normally it really depends on the amount of money that you're raising. Obviously, there's going to be disclosures that you need to do and certain ways in which you file your offering with the SEC. But audited financials, for example, comes when you're raising over 500,000. So obviously, when you're at a seed stage, especially here in the US, you're probably going to be shooting for over 500,000. As mentioned, normally on seed, it is around 2 million, what I'm seeing in New York City, for example. But yeah, now the other question that you have is it a negative to buy this after there is interest? So it's really understanding what's going to be the outcome, Stan. You don't know how people are going to be reacting to your offering until you put it in the market. So that's a challenge. So the real problem here is that when you list yourself on a platform, there's really no way back. I mean, it's already available to the public. You've already listed the terms and everything. So you, at that point, are going to be able to know where there is interest. I mean, otherwise it's very difficult, right? So one thing that you could do, for example, is many of these platforms offer the testing the waters, and this happens for the regulation crowdfunding and for Reg A's and stuff like that. So testing the waters gives you an idea on who may be interested in your offering. Now, the problem with that is that mainly one thing is that someone shows interest, and the other thing is that people are willing to give you money to go into the bank. That's what I see a lot of times with founders where, you know, they come to me, I meet with them, and they're like, oh, we're doing a round and we have this amount committed. And then I say, great. So you have commitments, but how much of that is in the bank? You know, commitments is just commitments. It means nothing. So for me, a commitment is absolutely nothing in the bank. So I guess Stan is asking, what do you do earlier if you're planning to do a campaign? I think that it doesn't matter if you're doing a reward-based campaign or if you're doing an equity or debt-based campaign from a crowdfunding perspective. Basically, the whole idea is that you put together a timeline of, like, for example, 6 months leading up to the actual launch, in which you're grouping people that may be interested at first. So that's going to be your first degree connection, your first degree network, the people that are going to be putting that initial traction so that everyone else jumps in later. You're going to be grouping as well, or keeping abreast of your progress reporters. So this is going to be people that are going to be talking about the launch of your project, you know, to get more people that, you know, are outside of your network to come in, to create that excitement, that traction. The other thing is you also want to continue building your list. So I think that the list of emails that you have of your customers and interested parties is critical. So that's going to be the people that you're going to be hitting a couple of times leading up to the actual launch. You know, maybe you want to hit them like 3 times before the actual launch, you know, telling them about what you're up to, what you're going to be doing, what to expect, all of this kind of stuff. So that is for crowdfunding itself. If you have any questions, guys, feel free to type them in. Don't be shy. I will not be mentioning your last name for privacy. I will just be calling you by your first name. Okay, so Stan, question. Say a broker is hunting for you to generate interest. They know you need north of 500,000. Do they need the financials audited? Why not? Also, your book doesn't mention brokers as part of the effort. Is it a good or bad idea to use them? Yes, Dan, I actually believe I mentioned this on the book, but in any case, I think that for early stages, using a broker is a really bad idea. It depends on the broker that you use, right? Because some of these platforms, for example, are broker dealers. Now, if you are, and that's the way they get paid, because you need a broker dealer license in order to charge a commission on the transaction. Otherwise, you don't even want to touch these platforms, because there's going to be some potential claims and stuff like that, that with securities issues, so you don't want to be part of that. So that's just one due diligence item for you to consider and ask these platforms. Now, in terms of brokers offline, I think that they are, for very early stages, they tend to send very negative signals. And the reason for this is because at the end of the day, early stage is all about investing in people. You invest in people. It doesn't matter where you're at today. It's all about where you're going to be tomorrow. And the best introductions, or the best way to get your foot in the door with an investor, is who is introducing you. Now, one of the things about this, and you know, I'm actually going to, that's a good question, Stan, to go into the next section of what we're going to be touching today, is the social proof. The social proof that, you know, it's giving you that layer of trust towards individuals or towards institutionals is critical. The best way to get in front is by going into this website, and I'm going to put it here on the chat for all of you guys to have it. I would advise you to go, or recommend you to go into Crunchbase. There you can see what are the investors that are investing in your area, in your industry, direct competitors, indirect competitors. And then what you do is, once you have the investor, you go into their website, into their URL that is listed on this site, and take a look at, you know, what are the different portfolio companies that they have invested in, because many times they display those companies as badges of honor. So what you do then is you go into LinkedIn, you find the founder of that company, and you ask that founder for a meeting. Entrepreneurs, I'm telling you, they're all about paying it forward, about helping each other. So I think that you should secure a meeting with that entrepreneur or perhaps a phone call, tell them about what you're up to, what's your idea, and then ask them, would you mind making an introduction to this investor? And I would recommend you getting the LinkedIn Premium for this. I think it's fantastic. And yeah, I mean, those are the best introductions. The other introductions that are like really more on the, and excuse my language, more on the shittier side is when it comes from brokers, because they don't have your best interest at heart. They just want, you know, their commission and run. Also, lawyers, you know, is not a good introduction because they have a ton of clients and probably making a ton of introductions. Accountants, other investors. If other investors have not invested in you and are rejecting your opportunity, forget it. I think it's either portfolio companies or investors that have already invested in you. Those are the best introductions by far. And obviously the founders are like on a whole nother level. Any questions, guys, on introductions, on how to get the foot in the door, stuff like that? Just feel free to type them in. Now, talking about angel investors. So you have on one end the angel investor, the normal angel investor, and then you have the super angel investor. Now, the angel investor is the typical executive, senior executive at a company. Here in the US, they're putting checks of up to $250,000. Normally, it ranges like around $20,000 to $50,000 per check. And basically, the whole idea there is that this is people that have a full-time job and a good one, and that it pays well. And basically, what they're doing from their income or from their wealth is that they're allocating around 5% to really high-risk opportunities, such as your investment opportunity, as part of their portfolio. So my piece of recommendation is that you stay absolutely away, miles apart from all these people that are putting themselves on LinkedIn that they're an angel investor, because those are the $5,000 ticket people. Those are people that are going to be wasting your time, and time is money, guys. All righty. So next one. The super angels. I love the super angels. And who are the super angels? The super angels are people that are investing over $250,000, and that comes in different forms. So it's either just one individual that maybe has done an exit, they just sold their company, they have some proceeds, some liquidity that they want to allocate, and the best ones are these founders, because they have that mentality. They've been there, they've done that. They may not only able to give you money, but then also to be active money, meaning that they're going to help you with building the business, you know, on the strategy side. Maybe you bring them to the board, and then also with making introductions for business development deals, other subsequent rounds of financing. Those are the best ones. It's interesting because you see this trend that the super angel investors, you know, and also, by the way, they also come in the form of family offices, because these successful people, they have family offices that they allocate to making investments, and that's their vehicle. And all the billionaires on the Forbes list, they have their family office, even though they're very secretive and very hard to get into, you know, or tap into. And mainly it's because they don't put information on the internet or on WhatsApp family office or all of that stuff. There is ways to get to them. So, you know, you just need to work your network and your magic and, you know, do some research and you'll get there. You know, they're in many events and stuff like that in your industry. Now, one of the trends that I see on super angels is that once they've begun to do like a bunch of investments in different early stage companies, then you see them starting to create their funds. I mean, we've seen this with Peter Thiel. He went from financing Facebook as a result of his exit from PayPal and so forth to establishing his fund, a founders fund. You have this with Ron Conway, from like investing early in Yahoo or Google to creating SV Angel. You have many of those, and those are really super angels, and those are fantastic because they give you the larger checks, and the larger the check, the better a cap table you have, the cleaner it's going to be, and the faster it's going to be for you to close the round. Okay. So Don is asking here, what about incubators? Okay. So I'm going to get to that, Don, but just give me a couple of minutes, and I promise you that we will get there. By the way, Diana is saying that I need to speak a little bit slowly. So Diana, I have the Spanglish also that it's coming through. So I very, very much appreciate your patience, guys, with keeping up with it. And I'll try to go a little bit slower, Diana. Okay, so angel investors. So the angel investors, the way they structure their investments, it's in different types of forms and structures. So you have, as we mentioned, the individuals, you have the angel groups, and then you have the different structure that those angel groups use in order to put that investment in. So what I mean with this is, when you go into an angel group, you're going to be basically presenting to the group, and this is either via the pre-screening session that they do, or via the actual presentation day, the demo day, or whatever you call it. Now, the thing about the angel groups is that they have different ways of getting into companies, in the cap table of companies. So one of them is by, you go there, you present them, they like you, and basically they say, okay, so now everyone that is interested is going to be putting an investment in you. That's one. The other one is by creating the SPV, which we talked about before, and the other one is the venture fund. So many of these groups actually now have created a venture capital fund, and it's interesting because now, as you take a look into the investment landscape for venture, you see that investors are getting pickier and pickier and pickier as we go in time. So to give you an example, here in New York, Series A round back in 2005 used to be like around, what was it, like around $5 million, $3 to $5 million, a Series A round. Now, a Series A round, when you have like the Sequoias or the Axel coming in, it tends to be like up north of $10 million. And the reason why they do this is because now their funds are getting bigger, and going with smaller tickets, it doesn't really justify their time. So that's one of the trends that that we're starting to see all over the market, no? Okay, let's see here. Next slide. I want to talk about the VC structure. And basically the VC structure, because many of you guys at some point, especially if you're dealing in a high growth environment, it's most likely that you're going to have to raise subsequent rounds of financing. So on the VC, you're going to have the limited partner, as you see there. The limited partner is the investor in the fund of that specific institutional investor that you're looking to tap into. You have and they don't have any say, they don't participate on the investment thesis, they don't do any of that stuff. Then you have the managing partners. The managing partners are the ones that manage the operation, also the guys that participate in the decisions, and they do that in partnership as well with the general partners. Diana, let me know if the speed is okay now. And then you have the principals and the associates or analysts. Now, managing partners and general partners are going to be the guys that you're going to be seeing on the Monday meetings. So your goal with VCs is that your intention is that every single meeting, you secure the next meeting, because every meeting is going to give you the opportunity to address even more concerns, and as a result, get you even closer and closer to the money. Now, the Monday meeting, or the partners meeting, like they call it, which happens on Mondays or Tuesdays, typically that is your last step before you get a term sheet. And there you're going to see the partners just all coming in and listening. Now, the general partners, probably what you do to get your foot in the door is these people that, okay, Diana is happy with the velocity now. And if any one of you guys is experiencing any issues or whatever, please feel free to type them in. I'm reading all your comments. And everything is going to be shared, Jamshed, all the slides, video, everything, so that you can follow it at your own pace. But what I was saying is that basically you're going to be reaching out, you're going to be following that strategy that I mentioned about, the social proof and getting the best introduction possible. And really, what you want is getting a sponsor in that firm, a partner that is going to be a big fan of what you're doing and potentially the interested one, because ultimately that person is going to bring in all the other partners. Now, the other figures or profiles that you have in the VC is the principals. So the principals are in between associates and partners, but they may or may not have a decision when it comes to actually investing in a company. So even though they're great, they're not the best point of contact. And then the other ones is the associates and the analysts. Now, the analysts, and sorry if any of you guys is an analyst in a venture firm, are the ones that are pushing paper. And the associates, and also sometimes the analysts, are the ones that go to events and conferences to build the relationship and build up the network of the firm. And perhaps maybe if there's something interesting, then passing it amongst the other partners. Now, I gotta tell you that time is of the essence when you're raising money. You need to get to the decision maker as fast as possible. So if your only way in is an associate, get them to make the introduction as soon as possible. Analysts are a waste of time. Now, one of the things that you should be really aware of is that when you receive a cold email from a VC firm, and let's say it's an associate or an analyst saying, hey, I like what you're doing, you know, really cool stuff. It would be great to get on the phone with you to learn more. Basically, you shouldn't get excited. And I'm going to tell you very quickly why. The reason why they're reaching out to you is because they have agreed at a partnership level that your industry is a space in which they want to place an investment. And what they are doing is talking with you and with all your different competitors so that they end up placing an investment. Now, the last thing that you want to do is waste time with these people that are not only not decision makers, but also people that are going to be gathering intel to invest in one of your competitors. So do not waste your time. So whenever you have an analyst reaching out, you say, thank you, but no thank you. Great stuff what you guys are doing. Happy to discuss with one of your partners, but if not, I'm completely heads down with execution. You know, they'll get it. You know, they wouldn't get pissed. So that goes for the VC structure. Any questions, guys, in terms of about venture capital firms and VCs? Any challenges that you're experiencing with them? Feel free to ask. Because I know that like many times, like the VC investment is like the holy grail. For example, for my last company, we had, I think, 14 venture capital firms that were in the cap table as investors. So, happy to share, any experience, from that, from helping other companies raise money, from all of that stuff. So just feel free to ask. Now, in terms of how the VCs get paid, you are going to consider two things. So one is via the management fee, where they typically make like 2 to 2.5% of whatever funds they have under management. And then also the carried interest. So what that means is, for example, if they do a $100 million fund and they finally, after investments and everything, they take out 200 million. Then if the carry is 20%, which is typically what industry standard is at this point, if that's the case, then basically what happens is that they return they basically return their first 100 million to the LPs, to the limited partners that invested, and then they take 20% from the profits. So in this case, they would be taking in 20 million, and then the other 80 million, they give it as returns to the investors. So that's really the way VCs get paid. Now, there is issues with this. And the issues is that VCs or their funds have a lifespan. Normally, it ranges between 5 to 10 years. Now, you're going to run into trouble if you get a VC as part of your company and you give them enough power or enough vote in a way in which when it is time to actually go into liquidity with other portfolio companies because they need to return the money to their LPs, they may put you through trouble. They may want you to sell when you don't want to sell. And maybe if they control the board or they have more power or whatever, or they can do a proxy with investors, then they're going to actually end up selling your business. So I think that if you're finally getting money from institutional investors, there needs to be a clear alignment. There needs to be very clear expectations between you and them. And also you have a really good corporate lawyer that is looking through your documents, because many founders, they try to cut corners and they're like, you know what, I'm going to sign these equity offering documents and you know, everything seems straightforward. Now, the main issue that you may run into is that some of the clauses that may make no sense today, they may very well be the ones that get you kicked out of your own business in the future. So make sure that you have a good corporate attorney that is reading everything for you, that has your back, and that has your best interests at heart. Okay. Okay, perfect. So Stan is asking if it would be possible to the earlier stages. So we're going to be talking about, Stan, just so you know, because he's asking also about the pitch and, you know, what's done, you know, around that. The second session is going to be all about the pitch decks, the elevator pitch, and the 18 to 24 month plan. And then the third session, just so you guys know, is going to be all about the closing. So we are going to touch on that, Stan, I promise. And perhaps, you know, this is also interesting to you, which is the other resources of capital. Most of these are really for early stages. So you have the bootstrapping, where, you know, this is probably the best, where you're getting the actual financing from your own customers. The accelerators, I got to tell you guys that accelerators, for the most part, are a huge waste of time. I think that there is maybe like one or two that are great accelerators, like Techstars or Y Combinator, but then for the most part, the other ones are noise. And the reason why I say this is because you go into an accelerator program so that they help you, or that they give you access to their network, and it could be their network of potential business development deals. It could be their network for, you know, additional investments. Now, the real issue is that many of these guys don't really have much to give you. So maybe they're going to help you with the product, and maybe they have one investor here, one there. My advice is that if it's not a top tier, recognized top tier accelerator program, you can allocate, because you're going to be giving away of your equity 5 to 10% of your business for like $25,000 or $50,000, which is peanuts. You're going for, obviously, for many of your businesses, many others, you know, may really, you know, do great stuff with that. But, you know, here in New York City, you know, you can't really do much with that amount. But the thing here is that you may want to get that 5 to 10% and really build an advisory board in which you're giving stock options, where you attach them to milestones, so that you don't have to give that equity away for nothing. You give that equity away to people that are going to be not with you for 4 weeks or 6 weeks or whatever the hell that accelerator program lasts, but are going to be with you for 1 year or 2 years. And if they help you to reach your milestones, the milestones that you agree with them, they unlock their stock options. And if not, goodbye. You know, it's as simple as that. So it's less risk for you, more people involved, and more value if you do it yourself. The other thing is the friends and family. I would really recommend you guys to stay away from friends and family. They are going to be, it's going to ruin your life. You're going to go to dinners. They're going to ask you what's the valuation of your business. If they are not sophisticated, they're going to be calling you. They're going to be wanting an update. It's going to be a full-time effort. So stay away from it if you can. And then the other thing is bank loans. You know, it depends on what's the stage of your business. You know, there's ways to get to secure like a venture debt round, but that's more in later stages. That's if you have like some receivables or like stuff that, you know, is tangible and that they can see and project. At that point, you know, you can have like entities like Silicon Valley Bank, or, you know, there's like a couple of them. And then the other thing is the credit cards. I would definitely advise you to stay away from that. That can, you know, it's like once you pop, you can't stop. So that's problematic, and that puts you in debt. And the problem as well is that you do not want to have that on your record, because when, for example, institutional investors are considering making an investment in you, they're going to do all types of background checks, background due diligence on you. So everything is going to come out. So just try to keep a clean as clean of a profile as possible. So Steve is asking, can you further describe the VC carry? So really the carry interest, Steve, is what they get from the investments, from the returns. So they get basically a percentage of whatever returns they are able to provide to their investors, the investors in their fund, which are the limited partners. So that carry typically is around 20%. So for example, if, like I was saying, if you invest 100 million and the complete returns, the entire fund, when it's the moment to cash out and to distribute the proceeds ends up being 200 million, then first you give the money back to the investors that they invested, and then as the VC, you take 20% or whatever percentage of carry out of their returns, which would be the other 100 million. Does that make sense, Steve? I'm not sure, Steve. Okay, fantastic. Steve says that that's clear. Okay, so I have a question from Don. So Don is saying, I've got a great corporate attorney. He set up our company like Google or Facebook with Common A, with 1 vote per share, and Common B with super voting rights of 10x. Will this spook or scare away investors? I think, Don, that would be a huge mistake. You would be shooting yourself on the foot right from the start. There is I'm not sure right now if this is true or not, but there could be some tax implications. And then also and you should discuss that with your accountant, but investors would not like that. Investors would not like that at an early stage because you're complicating the entire structure. And I think that when it comes to financing, you want to structure your company in the most simple way so that you don't have to address concerns. Because here's the thing, Don, if you do that, not only you may be scaring people off, but you're basically adding more questions on top of the table that you're going to have to address in order to secure financing from potential interested parties, Don. So, when it comes to like Google or Facebook, they did that at a much later stage, not during the early days. So probably if you're like in later stages, and maybe, you're like Series B or Series C, in the life cycle of your business, perhaps maybe it makes sense and you can create like that partnership with other people in the board and other shareholders where they give you the voting of their shares so that you can continue to execute the vision and the mission that you had and that you aligned with them. But I think done that early on, probably, it's just complicating things without really having a reason to do so. So hopefully that addressed that question, Don. Okay, so you have accelerators. We talked about this. Friends and family, this is how the Thanksgiving dinner is going to look like if they invested in you, all asking for an update on how the business is doing, if you close your round, if finally you were acquired, if they're going to get their money back, that type of stuff. Avoid it. Avoid it. And now we're going to be talking about valuations. So it really depends, obviously, on where you're at. Now, this is some of the things that I'm seeing here in the US. So you see, for example, on the money that is raised, pre-seed or seed, it ranges between 200,000 to 2.5 million. Series A is between 3 to 12. Now you see going even, higher than that. Then you have the Series Bs, which is over, 15 or 20 million. And then the Series Cs, which is 20 million and up. Now, as you probably see, everything before the Series A is just seed. And then Series A is when you have institutional investors coming in for the first time. And then it's Series A, B, B, C, D, whatever, until you do the actual liquidity event, meaning that you either do an IPO or your company is acquired. So that's basically it. Now, one of the tips that I'll give you guys is the valuation, putting the valuation, the price tag on your business. It's really an art. So normally that happens when you have a lead investor. So that means someone that is coming in and that they're taking 20% or more of your round. And then as a result, they put a price tag and then everyone else comes in. But in most instances, especially if you're very early on, you are going to be maybe putting it yourself and putting together a syndicate of people where they jump in. Now, if you do this, make sure that you add in your pitch deck a slide that shows yourself and then other companies that are competing directly and indirectly with the amount that they raised and also being at your same round of funding. Because as a result of that, when people come to you and they tell you, hey, your valuation is a little bit high, you can say, okay, that's great. But if you take a look at our competitors, they raised actually at these levels, and this is what the market is paying. So I actually had one of those instances. And I remember, like, when I threw that, it's just like, it just kills it, you know, because every time, you know, you go fundraising and you're still, you know, negotiating terms, they're going to try to negotiate you down. So you're going to have to really make it happen so that you kill, you know, further questioning on why, you know, those terms are fair. And the other piece of advice that I give you is that you treat this and you also make them understand that you're not looking to negotiate, because in a negotiation, there's always someone that wins and someone that loses. That basically what you're looking for is a partner. A partner, and in a partnership, everyone wins. And that's really what you are going after. Now, another tip. I think that when I asked earlier, you know, I asked all of you guys, who here is fundraising? Many of you said, yes, 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 I'm fundraising. Well, you guys made a huge mistake. And the reason for this is because you never say that you're fundraising. And, you know, obviously I'm just joking here and it doesn't matter because it's me. But when you're out in the real world, never say that you're fundraising, because what happens is that the minute that you say that you're raising money, the clock starts to tick. That means that if you go back to that investor in 3 or 4 months from now, and you say that, you know, you're still raising money, and if they're interested in joining, then they're going to think that everyone else rejected you, and that's why you're coming to them. So my advice, my recommendation, and what I would do in your shoes is always, like the saying goes, you go for money, you get advice. You go for advice, you get money twice. And that's really the way it works. So really, until you don't have a lead investor, always go for advice. You know, go for people, seek their feedback. You know, maybe you put yourself like a timeline in which, you know, you are following up with them, you're asking for their thoughts, for their insights, and that's really the way it works. And then, you know, during one of those conversations, maybe one of these investors is like, hey, I think your idea is fantastic. Are you by any chance looking to raise a round? And then maybe, you know, at that point is where everything opens up. You know, they make the investment as the lead investor, 20% or more of your round. And then what you do is you go to everyone else that has been giving you advice and you say, we finally got the round open. It will be fantastic. I would love to share this journey with you. We need to go back to execute on the business. So, you know, if we're actually looking to close this round by X date, you know, it would be lovely to have you beforehand. If not, you know, I totally understand. So that way you're creating that level of urgency, that level of exclusivity. And fundraising really is like a train. Investors, when there's a train on the station and it's about to leave, they know that if they don't get in, they have the chance of losing their ticket or having to buy another ticket that may be more expensive later on. Now that's the image that you want to project. Now the other one is the train that never leaves. You know, it never leaves. It's always there. So they're like, it's gonna be there. So why the hell would I get in? So that's really my 2 cents here, guys. So really never, ever say that you're raising money unless you already have the lead investor in place or 20% of the round covered. So Jam said, is it better to use a third party to do the valuation analysis for you? Jam said, I think that using a third party, you know, it's good to do what it's called the 409A valuation. And that basically is, you know, how you're pricing the stock for employees and stuff like that. But I think that really when it comes to valuations, what you need to do is do some research. You can go into, for example, Crunchbase. You can go on Google and try to find out what are the valuations of these companies that are directly or indirectly competing with you. And then just put it in between, you know, and it's something that is fair. Okay, so question from Steve. Do you advise in fundraising for as much as you can get or raising only as much as you need? I think, Steve, that I got to tell you, I love this question. My take, or the way that I would say this, is raise as much as you can, as much as you can get. Because the problem is that while, you know, you may be in a strong position today to raise money, you don't know what's going to happen tomorrow. You don't know if the market is going to turn on you. You don't know if there's going to be some tweaks that need to be added to the business model because a new competitor comes in and shit hits the fan. So I think, Steve, that you raise as much as you can, but obviously you need to be very careful with how you are really presenting that to people. I think that the best way to do this is you go out, if you're already with the round open and you have the lead investor in, you put on the amounts that you're raising, and we will touch on this on the pitch deck on the next session, but you would basically say, you would not go with a specific amount. You go with a range. Instead of saying, hey, I'm raising 2 million or 3 million, you say, I am raising between this amount and that amount. And the lower amount is the amount that you know absolutely for sure that you can accomplish. Like, let's say, for example, if you know that if you're raising 3 million, but you know for sure that you can accomplish, let's say, 2 million, then what you want to say is that you're raising between 2 and 4 million. Why? Because if you're certain about reaching 2 million, then, when you have that sense or image of you've made it to what you wanted to raise and now you're oversubscribed, then you're going to get more interest from people. And then also when you give a specific amount, then there's people that have in their investment thesis that they can't invest, over, let's say, 2 million, or that they can invest anything, under, $3 million round. So this is a really good way to get everyone coming together. And that's why you use the range in between. So Steve, hopefully that answers your question. Now, in terms of due diligence, I'm going to share here like a really funny story. So the due diligence doesn't happen right after you get the term sheet. And I'll tell you guys a little bit about the term sheet later, but basically the due diligence comes the minute you have the foot in the door. These guys, especially the institutional investors, they are very good for reading people, and they have a pattern recognition with that. So as an example, I remember with my co-founder, we went to Sequoia, and we met there with Alfred Lin. Alfred Lin is the guy that built Zappos and Link Exchange. I think Zappos sold for 1.2 billion. Link Exchange, they sold it for like 250 million. So like a serious rock star. And we sat down, my co-founder, who happens to be my wife, Tania, we sat down across from him, and he looked at us and he said, what is the relationship between the two of you? We didn't know what he meant, and we could not believe that he was so quickly at catching it before almost even talking. And I said, we are dating. And he looks at us, he raises his eyebrows, and he looks at us and he says, do you guys know that this is going to affect, for the good or for the bad, your relationship? Obviously, we didn't know what he meant at that point. Later on, I sent him a link to the proposal, and I said, you were actually right, we're getting married. And he loved the video. I mean, I think we both got a good laugh out of that. But what I'm trying to tell you is that the due diligence happens the minute you have your first interaction with with that investor. It can be by the email introduction, by the way you conduct yourself on emails, by how you behave in person. Normally, the investor is going to know if they want to give you a shot or not in the first 2 minutes of conversation. So that's really all it takes for them to make a judgment or a decision on whether or not they want to move forward with exploring anything with you. So keep that in mind. So normally, again, the due diligence, it's going to happen for the most part, on the team with the individuals like the founders, management team. Make sure that you're not talking over each other during meetings. That leads to thinking that there's going to be potential problems with who leads really the charge, and I don't recommend that. Then, make sure that your market is big enough, because the market really justifies the potential returns that they can get out of this. It needs to be a market that is growing over time, and then also a market that is in the billions. If you are looking to get institutional investors, really the market is what is going to determine how much money they can make from investing time and efforts and placing investment in you. So make sure that is 1 billion and up. So let's say here, Stan is asking, if it advances this session, please offer your own company's history as one example of fundraising, chronicle timeline, covering funding type, ranges, and number of investors of each raise. So I think that really, Stan, it varies from case to case, in terms of like how much you raise, from who, from what. For us, it was in different tranches. So we raised almost 7 million for the last company. And basically, we did that in different tranches. So, we did a seed, then we did a Series A. Actually, the Series A, we raised it from our own customers, which was pretty cool. Online in less than 30 days. That was unbelievable. But it really depends. It really depends, Stan, on your company, on your status, on the market, on your traction. So I think that the best way to do this is, you just go like as I said, like these are, for example, like in valuations in this slide, you see like the different types of companies, life cycles. So just try to structure your way so that, you put it in a way in which is what the market is paying and the market is doing. You don't want to be completely off. And you don't want to be like not there, yet, or not in where the market is. The other thing that you're saying is you're talking about. You said something here. Let me see if I get back to it. Chronicle timeline, covering fund type, ranges. I cover the ranges, a number of investors of each raise. So probably what you're meaning with the number of investors is probably the dilution that a company, is willing to take per financing round. My recommendation to entrepreneurs is that they do not dilute themselves by more than 25% on any given round of financing, period. The reason for this is because really, if you dilute yourself heavily at the beginning, especially, then that's really going to take away the magic from you wanting to continue to push and to continue to execute. So really make sure that you're not over diluting yourself and going over the 25% mark. So Virginia is asking, if you have the option to raise financing through leasing a property instead of renting and then using those funds to internally finance the business, would this be considered risky? I mean, I think that, there's always creative ways, Virginia, of finding financing. I think that any creative way that is going to be, avoiding you from diluting yourself, I think it could be an interesting idea, at least worth exploring. But at the end of the day, Virginia, you really know your own business, and no one knows it like you. But again, there's always creative ways on getting it done. If you don't have to raise money, don't, because raising money creates expectations, and you're going to be, having people that you need to report to. So again, we already covered this, but really what investors look for is a team. Is for example, like the book Good to Great from Jim Collins. I love it. You guys should read it. And there it says that an early stage company, what it is a bus without a direction. You need to have the right people seated on the right seats of the bus in order to find the direction towards success. And really, that's what the early stage companies are. What my advice is that if you have a product that is heavy on one area, make sure that you have like a founding team member that is covering that, or maybe like an employee that is heavily attached to a retention package in the form of stock options or some cash incentives. And the reason for this is because, for example, if you are, let's say, a tech startup, just to put an example, and you are outsourcing your code, the engineering efforts, it's going to be very hard to raise money, because that is adding another layer of risk to the actual investment of the investor, and most likely they're not going to invest in you. Now, ideas are great. They're just 5%. Traction is everything. I think that what you should do, and we'll talk about this on the next session, is that in terms of traction, you want to make sure that you nail it, that you're heavily focused on one metric, that metric that really determines the health of your business, and a metric that is growing over the course of on a monthly basis. Because they're going to ask you for that. So you want to make sure that you show that and that they see that it's trending upwards. The other thing, we already covered it, which is the market opportunity, and then the competition. Everything, guys, it's going to come out. It's going to come out on due diligence. It's going to come out on the disclosure schedules. Never lie, never oversell, because it's really a turnoff. And just keep in mind that you're not the first one to do this. You're not the last one. There's, like Mark Cuban says, there's at least 100 people that have thought about that same idea that you're executing on, maybe directly or indirectly, but they have tackled it from one direction or another. So just be completely, fully transparent and upfront. It's okay, but never lie. Okay, so we have Jose Luis, any thoughts about traction and revenue metrics, investor references? So in terms of revenue metrics, it really depends on the stage of your business. So for example, accelerator programs like Y Combinator, they do request that you have at least anywhere between 10 to 15% growth every week. Obviously, that's not sustainable as you continue to grow your business. But I think that around this metric that you're going to be completely obsessed about, you at least need to have 10% growth every month. Otherwise, it's going to be an issue. So make sure that you have it in that direction. Otherwise, getting them excited, it's just going to be tough. Now, some of the questions, and Jose Luis, this may address your question. Some of the questions that you're going to be getting from investors, most of the time they're going to be the same questions. Those are people, especially if you're talking to institutional investors. These are people that are talking to all your competitors. They're going to be talking with everyone, and then once they've talked to everyone, then they're going to be like, well, that individual or that company we like, and it may be our bet. So the questions that they're going to be asking you for the most part are going to be around the burn rate, also when you become profitable. Now, I would say that the trend is not like in 2005 where, you would see companies that it was growth above everything else. Cases like Uber are great, but it's very risky. And I don't think that now, unless say you are a successful exited founder with experience, you may be able to accomplish and get away with that. Your dollars, really count. So really make sure that you understand how to get those revenue streams in the door. And then the other things we talked about, I think that one of the things that they're going to ask you is, what is your advantage? What is your advantage above all your other competitors? And this is going to be, the distribution that you essentially have. What partnerships do you have? Perhaps, there is a system or a patent that you have in place. So those are things that to investors are really important. Then the other thing is, how are you intending to use the proceeds of the money that you're raising? So I remember I was part of a panel that it was for I think it was an angel group. There was like it was like a demo day, and we were all sitting there and listening to pitches to see which one was going to receive the investments. And one of the founders, and this was in New York City, and one of the founders stood up, started to present the company, and everything was well. And then all of a sudden they get to the use of proceeds slide, and they say, oh, we're going to be allocating 20 to 30% of the money that we raise to hiring people. And most of the people are going to be engineers. And the salary of these engineers is $50,000. So at that point, it was a turnoff. Everyone was turned off. Why? Because engineers in New York, for example, they cost between $80,000 to $150,000, right out of college. So you want to make sure, that's like what the Facebooks and stuff like that are paying, by the way. So you want to make sure that you got your numbers right. Otherwise, you're going to scare people off. So keep that in mind. So this is a tip. Investors, as I said, they are always going to ask you the same question. So after every meeting, just write all these questions down. Write them down. Then you can go back, to your team, speak with them, with the management team, and say, hey, those were the questions. How should I address them better? What do you think? And that way, each meeting that goes by, you're getting better and better and better at addressing those same questions that you're getting. All righty. So the funding vehicles, I believe one of you guys, I think it was Stan, was asking about the structure. Guys, if you have any questions, please type them in. I'm going to address every single one of them. I want to make sure that no one leaves with questions unanswered. So ask them. The structure can be either via equity or it can be via debt. So there's different types of like debt, like convertible notes, KISS, safe notes. You name it. Now, The difference is that equity rounds, you're really going to be using those when you are getting institutional investors in. And by the way, one thing that I forgot to mention, one tip that I give you guys is avoid at all costs bringing in venture capital investors in any round that is before a Series A. And the reason for this is because you raise money not to build a machine. You raise money to speed up the machine. And what I mean with this is that you have everything figured out and the investors are coming in and they're dumping in whatever amount of money, and they know that as a result of putting that money in, they're going to get X amount of money out for the business. So it's very tricky because you have VCs, for example, in Silicon Valley, like 500 startups and others that are like spreading checks across the board, like $25,000 here, $50,000 there, $25,000 there, and all at very early stages. Now, the real issue with that is that if they're investing at a seed stage and then it's time to go to the Series A, the first institutional round, and they don't participate in the round, that is sending a huge negative signal to the market. So you are finally doing a VC round. Why is that VC that you already have in your cap table not investing? They're going to be like, well, you know, there's obviously something wrong in there. I don't want to be part of it. So unless you have, and you're sure, very certain that the machine is built and that, you know, you're ready to go and hit the ground running, and enough historical data that validates your model, do not get VCs before a Series A. Now, going back to what I was saying, equity rounds, great. If you have institutional investors, great. For Series A onwards, they are costly. They are going to take time, you know, anywhere between, I mean, it could be anywhere between 2 to 3 or 4 months, and it's going to be quite expensive. It can go from 15,000 all the way to 30,000 or even more. It depends on the time that is allocated, the complexity of the deal, that kind of stuff. And then you need to agree on all type of clauses. There's different types of agreements. You know, maybe some clauses don't make any sense to you, so be careful with that. And then the other thing is that you have the convertible notes. I think that the convertible notes and the KISS and the safe notes, the beauty about it is that for the most part, you know, you can delay the process of establishing a valuation. You can wait for the institutional investors to come in and really to put a price tag, which are the sophisticated folks. And the convertible notes are fantastic if you are in need of cash, and in need of cash very, very quickly. I mean, it could take like 2 weeks, 2 or 3 weeks to really get the convertible note round done. It's just two things that you need to really be focusing on. It's just the interest and then also the discount that you're giving away. So the interest is, you know, on the money raised, you know, on the money that they give you. Normally you give them an interest on top of that, you know, that accrues per year. What I'm seeing now is anywhere between 5 to 8%, you know, interest on convertible notes. But obviously you need to discuss and confirm this with your lawyer if you want to do one of them. And then the discount, it ranges as well between 15, and I've seen it all the way to 30 and 40%, but I would not do, if it was myself, a convertible note that is over 25% discount. It's because it's a turnoff for investors that are coming in later, and they're going to be like, why the hell is this guy getting such a massive discount and diluting us all by a mile? I think that you got to be careful with that. Now, that's the thing about convertible notes is that you need to be very careful with who you're bringing in, because convertible notes have a maturity date, and that means that the debt needs to be either repaid or converted into equity. Now, there is times where you may be getting in like this guy that is, you know, that has a different agenda. It's in it for the wrong reasons, and maybe they, you know, they get in. And, you know, for whatever reason, you are not able to raise another round, or there's not an event where that debt is converted into equity, because especially for early stage companies, that debt, you know, that convertible note is converted into equity. That's the purpose of it. But the problem is that if the maturity date is, let's say, 1 year off, 1 year out, or 2 years out, and you don't do the next round of financing, then that means that that debt is outstanding, the maturity date is up, and you're going to have to either negotiate an extension on that, which obviously if the investor is in it for the right reasons, they will agree. Or if they are in it for the wrong reasons, they're going to ask you to repay them the money back. Now, obviously, you know, that's going to put you in a pickle of a situation, and it could even, you know, bankrupt you and make you close the operation. So be very, very careful. Do not bring in pirates as investors. So the process of how your investors will exit is, very straightforward. As some of you may know, it takes time. It takes between 5 to 10 years for the successful exits, and they are in the form of IPOs, secondary market sales, or your company getting acquired by another player. And some of the different terminology that you would see here is the cap table, which is a summary of who has invested in your company and what. It's just like a record, keeping of everything, of the investors, percentage of ownership, all of that stuff. Term sheet, I would advise you guys to be very careful with it. A term sheet is not binding. So a term sheet is just a summary or a promise to invest, and the summary of the promise that they're giving you. And I've seen in many instances, and this is so unfortunate, guys, I have had plenty of people that I've met, that I've known, friends, founders, and they receive a term sheet and they get all excited. They start increasing their costs. They start hiring like crazy. And then for whatever reason, the deal falls through. And then they're stuck holding the bag. And then they're like, oh my God, I hired all these people. I increased my burn rate by a mile. We need to shut down. So be very careful with that, guys. Common stock versus preferred stock, basically that determines who is first in line whenever there's a liquidity event. Common stock is, for the most part, early investors, team members, advisors, directors, and so forth. And then let's see here. We have a question from Stan. A scenario: Series A debt equity fully convertible. Forget about dilution; it's horrific. What would a reasonable multiple of the debt be to make it not an issue? For example, 2 million debt and 2 million raise would be useless. 10 million raise may convert. The debt and buy out the conversion for more favorable terms. One investor from day one. What's a likely scenario to play out? Assume the company is attractive, in a good market, not yet showing revenue, but highly potential. I think that, instead of like doing any paybacks of the debt, Stan, I think that probably, I don't know what structure you have in mind or how you're putting that together, but for the very early stages, if you're doing a seed or maybe a Series A, then that debt, can be raised in convertible notes that are converted in equity. Now, if you're much later on and you're doing a venture debt round, like for example, like from like a Silicon Valley bank, then they want to have like some collateral for that. And probably what you want to do is, if you're looking to raise on the next round, let's say $10 million or $20 million, and you've gotten, let's say, 5 million in debt from them, maybe you raise 25 million. So that way you return the 5 million, and the remainder of that 25, the 20 million goes into building the business. So that would be, a good way to do that. But yeah, it depends on the stage that you're at. So in terms of the notes, one of the things that I didn't touch on really quickly is that notes can be capped or uncapped, as Steve pointed out. Now, the thing about the valuation caps is that it's indirectly a way to putting up the valuation on your deal, even though it's a debt round or a convertible note round. But really the cap, the way it works is, for example, if I'm raising, let's say, 5 or 2 million today, like we were talking about in seed rounds. Basically, what I would do is, let's say I'll put a cap of around, let's say 6 or 7 million. I'm just throwing in numbers, out of the blue. So basically what happens, the way the cap works is that if I was to do a subsequent round of financing, let's say a Series A round, that has a pre-money valuation of, let's say, 15 million, it doesn't matter for those investors that invested at the convertible note, because their note is going to be converting at 7 million. It doesn't matter if your round next time around is 20 million, 30, 40. They are coming in always and converting their notes into equity at the valuation that you gave them on the cap. So indirectly, with a valuation cap, you're putting up a price tag. But yeah, that's really the way it works, Steve and everyone else. Okay, dilution, we already talked about that, so we don't want to touch on it again. We talked about the different options for returning the money back to investors, and then the pros and cons. Obviously you get to go faster. You get to execute, do whatever you want, more resources. The concept is that you're giving away back or giving away equity. That's equity that you're not getting back. You're going to have to report to investors. Reports are going to be, for the most part, it depends on your stage, but they could be weekly, they could be monthly, they could be quarterly. So it really depends. Now, I want to talk about the timeline. So in terms of the timeline, so normally you want to give yourself 6 months before you run out of cash to really start getting into raising money very actively. Because here's the thing, as a founder, you're going to be raising money 24/7. You're always raising money. That means building the relationships, like building the report, all of that stuff. But there is times that you're going to be more active than others. And when the activeness kicks in is when you have 6 months left of cash, meaning that if a miracle or revenues really kick in hard, you're going to go out of business. Now, what you want is this is really the way it works. So you're going to be getting that introduction for the person that we talked about. Then maybe there's like they ask you for something that they can share internally or something that they can look at. That could be a pitch deck, or it could be the executive summary. Then there is the first call schedule. But as you see, the intention is you just keep going and keep getting more meetings so that you keep building that trust, with them. Because basically what's going to happen is that you're going to have your first meeting, and then probably there's going to be like 3 months that happen in between your first in-person meeting and the second one. In the first in-person meeting, they're going to ask you, like, where are you at? What are your projections? What are you looking to accomplish? And it's always, always, always the case that the ones that over-deliver are the ones that have the higher chances to raise the money. So my piece of advice here is that when you sit down for the first time, you give them numbers that are incredibly conservative and that 100% that you can accomplish, because later on when you come back, let's say 3 months later, you would say, hey, remember that chat that we had that we were going to do these numbers? You know what? We actually tripled those numbers. How cool is that, right? So then you're going to activate them. They're going to get excited, and everything is going to be altered. So keep that in mind. Don't do like many accelerator programs do. Oh, just add another 0 to the right. It's going to make it look cooler. That is just adding to yourself, more expectations, more potential, under delivery, not delivering on the promises. It's just a whole mess. So don't do that. Alrighty. So some of the reactions that I please do not have is that or actually that investors are going to have, sorry, the ones that you would have, we'll talk about them in a little bit, but they may tell you that you're too early, that you don't have enough traction, blah, 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 right? Like the typical ones. I mean, how many of you haven't gotten one of these? Just say yes. Let's hear you out. Like you don't have enough traction, or you're too early. Okay, so I see here Jose says yes. So almost, wow. So almost every single one of you has received one of those. Isn't it funny? So this doesn't mean, guys, that they're passing on your deal or passing on your opportunity. It's not a no. Here's the thing, a no is never a no. A no means come back to me later. And that's basically, and it comes in the form of you don't have enough traction, you're too early. What they are asking you is to do the connecting the dots strategy. And what that is that you meet with them, and then you put yourself a timeline in which you're going to be scheduling follow-ups, and that could be in the form of emails, it could be phone calls, or it could be when you see them, in which you share with them new developments on the business. That is, you've achieved a certain amount of revenue. That is, you've hired, that person that you promised that you were going to hire. That is, you have achieved or you've been featured in whatever press articles, stuff like that. Because at some point, that no, I promise you, it's going to turn into a yes if you are, if you have integrity, if you're delivering on your word, right? Yes, Stan is saying too early. Yes, that's always the answer. Absolutely, I hear you. And that's the thing, don't treat us a no. Don't treat, oh, I should give up on this investor. They said no, on to the next one. No. Remember, those responses are just asking you for more time, to give them more time, to give them more information, to address more concerns, and to deliver on your promise. Alrighty, so that's the connecting the dots, which we talked about it. So then there's other, areas in which you're going to be getting rejected. And, it's funny enough, many of these guys, are really not going to reject you. They just want you to keep turning around. And the problem about this is because investors don't want to say no and then close the door on making a potential investment. They probably are going to say, oh, maybe you're too early. Sorry about that. Maybe you're too early, come back to me later. So that way, when you have, let's say, like a big investor that puts a big investment, then the door is still open for them. And they're like, oh, would it be possible for me to make an investment too? That's really the way it works. It works with these people. It works with those guys that are telling you that they're committing X amount of money to your venture. That is nonsense to give you commitments. What they need to give you is the money in the bank. Commitments is just leaving that door open so that, oh, if someone else invests, I'll come in as well. Commitments mean nothing, guys. So you got to get that money in. So some of the things that you have here is the market being too small. We talked about that. Key pieces of the product. They're going to bring in advisors, by the way, to check your source of your source of code, your whatever lines of business that is critical. They have advisors for that. So they're going to look into that. Make sure that you have the team and you have everything organized and everything cleaned up. Projections, be very conservative. Don't be, like crazy about that. And then also if you've had, potential things that may come out on the due diligence process or on the disclosure schedules, make sure that you can, how would I say this, prepare for the concerns that are going to come out of it. So for example, if you have bankruptcies that have happened, those are potential red flags. Obviously they happen, but they are potential red flags and you're going to have to address them. So that goes for that. Now, big no-nos that I would recommend here is never get angry with an investor. It's going to be a turn up for them. All the investors, it's a small world. They all talk. You don't want to cause a negative impression in that sense. Just always say thank you, and goodbye. You don't have to take all their feedback. Sometimes yes, sometimes no, but at least be coachable. Be appreciative of their time and whatever they're saying. Even though you don't like to hear it. It's your baby. I've been there. I know what it feels like, but it is what it is. The goals, make sure that you always over deliver, never lie about anything, and then receiving interest from the wrong person, that's not something that you want, because then you are starting with the wrong foot. So qualities of successful founders, these are some of them. I think that the best ones are the ones that really overall, not the ones that have that are the greatest visionaries, but the best founders. The greatest visionaries, but the greatest founders are the ones that can sell, the ones that can be unbelievable storytellers. It's all about storytelling. It's about telling your story, because really at the early stages, they are not investing in your product. They are investing in you. They are investing in the future, in the potential. So that's why you need to really give them that story, enroll them on the future that you're trying to create. And I think that would be also inspiring, and also would get them, encouraged to really be part of the journey and share it with you, So if you have just 6 months left of cash and things are getting a little bit tighter, there's different things that I would recommend you doing, because we've all been there. I mean, I remember one time, where, we were it was crazy. It was literally weeks away. We were at the point where we were starting to think who are we going to start to fire at this point? Because we were negotiating this deal with an investor, and, we were not able to close, and it kept, delaying and delaying and delaying. But yeah, I mean, it got really tight. So I think that, you always want to prepare for the worst and hope for the best. And, with that being said, try to just keep whatever is critical and whatever is necessary for the business to continue this at the same speed. That means decrease headcount, for example, the people that you don't need or the people that are nice to have. Cut unnecessary costs, for example, retreats and, meals and stuff like that. Spend every dollar as if it was your last. I think that avoid, if possible, getting a fancy office space and things like that. That's completely unnecessary. And then the other thing is become cash flow positive if you can, as fast as possible, because basically, if you do that, you know, that's also going to give you more leverage towards investors to negotiate the deal that you like. And it's not going to really put you in a tough situation. So that would be my piece of advice. So again, guys, we are starting to get towards the end. So ask any questions that you have. You know, I'll be happy to stay a little bit longer if needed. And then Q&A, we had that during the session, but please ask any question now. And while you throw in whatever questions that you have or not, you know, we have some homework. We have some homework to do for the next session. And on the next session, I want to focus really on the pitch, meaning how do you get in front of people? How do you present yourself? How do you present your business? What's needed to do that, the structure, and so forth. There is 2 videos that I want you to watch before we arrive to our next session. So one video is the presentation that Steve Jobs gave of the iPhone. I really want you in this session to keep your ears very open towards the linguistic that he uses towards enhancing whatever he's saying that excites the people that are in the audience. And then I also want to take a look at the presentation of Elon Musk of the Tesla power battery, where basically, you know, you need to keep an eye out for his level of authenticity, his level of just being there, just being himself. I think that that helps to really just be one member of the audience and really just feel like he's having a conversation with you. Because here's the thing, people need to connect with you. They need to like you. And if that happens, then ultimately they will make the investment. So you got to be authentic. The other thing for the material that we're going to be covering on the next session, you want to take a look at the book and read the chapter 4, the chapter 9, and chapter 11. And basically on those chapters, I'm covering the sections of pitching, amongst other things. So take a look at that. And by the way, the reading is very quick, so it shouldn't take a lot of your time. And then just so you know, and that we're all clear, on the next session, we're going to be covering the elevator pitch, the pitch deck, the executive summary, and the 18-month plan. So yeah, so that's basically what we have for the session today. I just want to say that it's been, guys, a true pleasure to be here on the first session. It's a real honor to be your coach. We're going to make it happen. You're going to leave, you know, by the end of the third session with the knowledge on the strategy and the psychology and what, you know, it's to be expected and how to do it, when to do it, and all of that stuff. So we will make it happen together. So thank you so much for the trust in me, in being your coach. And I'll see you guys next week. So keep an eye out as well for the follow-up email that I'm going to be sending later today, in which I include the slides and also the recording and also the homework. So with that being said, thank you so much, everyone. Have a wonderful rest of the day and take care. Bye-bye.